Hey, it's Tom here and welcome back to the channel. It is monthly Q&A time here yet again, and not only is it monthly Q&A time, but it is Christmas Q&A time and probably the last YouTube video of the year here on the channel. A massive thank you for the support right throughout the year, both here on the main Investing with Tom channel and also on the Investing with Tom podcast channel. It's been a really cool year. And I hope you have a great holiday season, however you choose to celebrate it, and whether or not you are in freezing winter conditions in the Northern Hemisphere, or you're down here enjoying summer in the Southern Hemisphere like me. So with all that said, let's get straight into some questions. Now, we've got a couple here actually on goal setting. So firstly from Henry. Hi Tom, have you done a review of your 2022 goal setting plans? Have you hit your target? I'm not as organized as I could be, but not bad. Cheers. Thanks for the great videos. Have a good Christmas and New Year. Thank you, Henry. And we've also got another one along similar lines from Carol. Kia ora, have you set your goals for next year and will you share them with us? Yeah, so anyone that's been following the channel for a long time might recall that in 2021, I actually did a couple of different goals videos. I think I did the same in 2020, where in 2021, I put out my goals out into the YouTube world at the start of the year so that you guys could keep me accountable. And then I did sort of a year in review, kind of how I've gone type video as well. So I didn't end up doing that in 2022. A lot of the goals for this year were pretty similar to what I had last year, just kind of scaled up a little bit. But notably, we did have the goal of purchasing our first home this year in 2022. So in terms of how things have gone, we did buy our first home, which is what I'm sitting in right now, so that's a massive one to have ticked off, and I'm glad we were able to do that. From a investing and personal finance kind of angle outside of the home purchase, I had the usual goal of buy 1 to 2 new stocks that I thought were compelling opportunities, kind of taking that Warren Buffett punch card type approach. I've added to a few stocks that were existing positions in the portfolio before 2022, and I did purchase one new stock, brand new stock this year, so ticked that one off. I did have like a money saving goal, which unfortunately I fell slightly short on. I was maybe being a little bit aggressive with kind of side hustle income sources that I thought I might get, but overall I'm pretty pleased with where we've landed financially in 2022. And in terms of 2023 goals, I think there will be a lot of the same kind of structure again, but obviously scaled up again to get a bit more growth and push a little harder in 2023. The only goal I've really set super detailed so far is actually to do with this YouTube channel and kind of the Investing with Tom podcast and so on. I want to grow the revenue coming from this YouTube channel and everything. For full transparency, in 2022 it's looking like we'll come in just a fraction under, probably about $40,000 in revenue from the Investing with Tom YouTube channel and podcast and sponsorships and all that type of thing. I'd like to grow that about 50%. So my goal is to try and push really hard and get that to about $60,000 in revenue for next year. So I've got some pretty detailed plans on exactly kind of what would need to happen to achieve that. But that's the only real goal that's a little bit different going into next year. I fully appreciate that it's pretty weird and kind of unusual to have that type of income outside of my regular day job, but I do put a lot of time and effort into putting out the best content I possibly can, and I really appreciate the people who watch these videos, because obviously if you weren't doing that, none of this would be possible at all. And of course, those numbers are not like after-tax profits that are in my pocket. I do have some costs on that, and have to pay tax on it and all that good stuff. But that's where we currently sit. Next question here is from Al Diety. Do you usually allocate a full position to a new stock right away, or do you average the position out over a few weeks? This has changed a little bit for me over the years. Generally speaking, I would split a purchase into at least 2 probably different price targets. Generally, I would buy at a particular price and maybe buy a little more if it went lower. there's no exact science to that really. It depends kind of on what cash I've got available and my conviction level kind of going into that company. But I am increasingly a believer in the fact that after you build an initial position in a company, you just, having skin in the game, follow it a lot more closely and tend to understand the business more and more and more as time progresses. So I've got stocks in my portfolio, for example, that I might have added to initially once or twice within a month or so, say kind of right out of the gate, and then I've bought them again like 2 or 3 years later because the price has come back down or the intrinsic value has grown, and I feel like it's got good opportunity to add more. So generally speaking, I try to split it up a little bit, but that's an evolving thing for me. That's kind of part art, part science, I guess. But good question. Next one is from Quant Compounder. What's your definition of financial freedom? Do you have a figure in mind you're happy to share? I'm sure it varies country to country, but would be interesting anyway. I think my definition of financial freedom is pretty straightforward. It's just kind of having enough assets and relatively passive income to be at the point where I don't have to work if I don't want to. If I still want to work, I can choose to do that, but I don't have to. That's kind of my definition. I've always sort of worked off like the 4% rule. So, having a lump sum of investments, and the idea is you can draw down about 4% of that capital each year. Your investments should grow at least 4% to kind of rebuild, and you can do that in theory for all of eternity. So that's what I've always tended to work off. I don't have an exact number in mind off the top of my head, I must say, but I have always sort of thought it would be nice to have like a fully paid off house alongside that. So, the annual amount I would need to live comfortably would actually be relatively modest, I think. But I tend to work off that 4% rule as a bit of a start. Next question here is from Matt KG. Would you ever consider doing a deep dive into how to value REITs, similar to your deep dive into how to value banks? I think I've probably done that on the channel quite a bit with Seritage. I did a property by property valuation, which was definitely a very deep dive for Seritage growth properties. So maybe check those videos out. Those are more of like a liquidation net asset value kind of approach to valuing a REIT. You could definitely do it on a net operating income basis and apply some sort of cap rate based on the type of properties that real estate investment trust owns. But REITs aren't particularly complicated to value, I must say. So you're really just looking at the cash the REIT is generating, putting some sort of multiple on that, typically based on the type of real estate they own, or you can do it some sort of liquidation value approach. And probably those two approaches are going to give you reasonably similar answers most of the time. With something like Seritage, they have a lot of properties that are sitting vacant or are in need of development, so they don't have as much cash flow as if they would with a fully developed and leased out portfolio. So net asset value will give you a higher number with Seritage than net operating income, but a standard kind of fully leased up portfolio of properties in a REIT will probably give you similar answers with either approach there. But good question. Next one is from Hamad. How have you been? Your mental state in this journey? Have you shared any positions out of your holding like Barber, SRG, or any other cloning position you have? Be honest and open. Lastly, thank you for everything. You are an awesome guy overall. Appreciate your hard work. To the moon next year, hopefully. Thanks for your question, Hamad. I've been pretty comfortable throughout this year. My portfolio has been pretty much flat, maybe even up very slightly, but I think about flat for the year. So I guess happy with that relative to what the index has done, but kind of is what it is. Obviously do your own work with your own investment portfolio, but in terms of Alibaba and Seritage, I currently own the most shares I have ever owned for both of those companies. That's not to say I've been buying them hand over fist or anything, but certainly haven't sold them down. Next question is from Jin. Do you plan to start trading options at any point in your life? I don't know about trading options, like doing super high risk, buying calls that can go to zero and potentially have a bunch of upside and all that type stuff. Certainly open to the Matthew Peterson style of selling put options to get into a company and selling calls to get out of a company. Haven't done it yet, but definitely something I'm open to. Next question here is from Just One. What have you unlearned this year? That's a very good question. I'm guessing that comes from the Charlie Munger, a year in which you don't kill one of your best loved ideas as a wasted year. I think that's roughly what Charlie has said. What have I unlearned this year? I think probably something that's really been reinforced for me this year is the importance of capital allocation. I think I knew that reasonably well already, but it's been reinforced this year, and reading a book like The Outsiders from William Thorndike has really helped with that too. The example I keep coming back to is something like GraphTech, which Monish Pabrai invested in, I think in 2019 probably. And the idea there with that company was pretty straightforward. It was like GraphTech's probably going to earn their market cap in the next 3 or 4 years, maybe 5 years, because they have these locked-in contracts for these electrodes that they sell for electric arc furnace kind of steel production. We don't really know what's going to happen after year 4 or 5, but we should have enough cash kind of built up from those initial few years to make the investment work out okay. And I think Pabrai was a little optimistic in terms of how much cash he thought GraphTech could produce. I think that's a reasonably accurate thing to say. But by and large, he was, I think, directionally roughly right with something like GraphTech. The issue was really the capital allocation, and GraphTech produced the cash, but it never really got returned to shareholders. I think the other thing I probably missed with that is GraphTech did have a lot of debt, and although they were going to earn their market cap in a few years, most likely they were not even close to earning, say, their enterprise value in cash over those few years. So a lot of that cash ended up going towards paying down debt. They cut their dividend to basically zero. I think they did a few share repurchases, but not a lot. So I guess what have I unlearned this year? Maybe just because something's cheap doesn't mean it's necessarily going to be a good investment. You often have to have the capital allocation alongside it kind of working well. Japanese net nets have been a good example of that for a long time, where statistically they look really cheap because they have a lot of cash on their balance sheet or whatever, but if the cash actually never comes back to you in terms of like a dividend or a buyback or gets reinvested in the business for growth, it's a little bit of a mirage that cash actually exists. And sometimes those big discounts to say the cash on the balance sheet just doesn't ever close. So I guess that's some things I've learned and unlearned this year. Next question is from Galzakan. How do you see a bank like Hingham surviving in the digital age? I guess what that's probably getting at is like the rise of lower cost fintechs and online banks as opposed to banks with physical branches and that type of thing. If that's not what the question really is getting at here, let me know in the comments below, but I'm guessing that's kind of what you're asking. I think Hingham management are very aware of money essentially being a commodity business, like money that you borrow from bank A spends the same as money you borrow from bank B, and so on. Same goes for deposits. If you're earning a similar interest rate at Bank A and Bank B, there's no real advantage, I guess, between those two different banks, as much as Bank A might tell you that they've got great customer service or whatever. There's certainly some peace of mind that goes along, I think, with having physical bank branches that customers can go to, but I think increasingly customers will probably care less and less about that. So I think, we're going to get increasingly commoditized over time, and for that reason, having very low costs is going to be a structural advantage. And Hingham scores really well on that front. If you look at their efficiency ratio, for example, which is essentially like the percentage of their revenues that they spend on running the operations, that's consistently come down over time to like extremely low levels. They're a very, very low cost operator. So that is definitely going to help. And I think management, like I said, are very aware of the long-term direction that something like the banking industry will go in with, lower and lower costs and increasing kind of commoditization of the industry, I suppose. So Good question. Next one is from James Peets. Would you ever buy an investment property? Yes, for sure. I think the price is probably just not right at the moment, at least in New Zealand. New Zealand real estate is extremely expensive, as I've come to find out this year. So yes, but probably not now. Question from Digby: did you coordinate outfits with the other YouTubers for this photo on purpose? I think Digby's referring to this photo, which is at the Matt Peterson barbecue in Omaha, and Digby was actually at this barbecue, the guy asking the question here. So yep, Brandon, Hamish and I were all staying together. I think we probably did the classic male thing of, hey, you guys wearing like a button-up shirt or a t-shirt, and I think we were all reasonably jet-lagged at that point and said, bugger it, we're just gonna wear a t-shirt and shorts, and we all tagged along. So I suppose you could say that we coordinated outfits. Next one is from Saga. Are you planning to attend the Berkshire shareholders meeting next year? Unfortunately not, but I definitely want to get back there at some point, hopefully 2024. Fingers crossed. Warren and Charlie are still in good health, but I know they're both obviously clearly getting on in age, particularly Charlie. So no, I won't be there next year, but if you do get the opportunity at all to go, I would highly recommend it. Awesome experience to go to the Berkshire Hathaway annual meeting in person, and it was quite cool, I think, to be there this year in 2022 after it's been at least a couple of years of not having the proper in Omaha, well-attended meetings. Okay, let's do one more question here to finish this one off. This is from Compound72. I know you've been learning about oil companies. Can you explain how you can get over the fact that commodity companies are usually tied to commodity prices, which tend to go sideways? What ways do commodity businesses outperform commodity prices over the long run? Yeah, I guess everything in investing comes down to the cash flow that a business can produce relative to the price that you're paying. So yes, commodity prices can be quite volatile. They certainly drive the earnings of commodity businesses to an enormous extent. But if you can buy and invest in commodity companies at a price that implies like a really low commodity price, for example, that is a way of getting a good margin of safety. So that's the way I kind of look at it. You can look at low cost producers, for example, like if a company can pull a barrel of oil out of the ground for $35 or $40 a barrel and their competitor costs $60 a barrel, then the first company is going to be profitable far longer than the second company if commodity prices come down. So yes, you're very reliant on commodity prices, but if the company price is right, you can still make it work even with pretty conservative assumptions. The other thing is, again, like the GraphTech example, you need, I think, in any business, but in commodity businesses even more so, to have a very good idea of what is going to happen with the cash when it turns up. So how are management going to allocate capital? And I think that's probably one of the main reasons you're seeing Buffett invest in the likes of Occidental and Chevron. Occidental, I think, have come out and bluntly stated the exact production that they're aiming to do, and that they won't grow production. So that's going to leave some surplus cash to funnel towards other things like debt pay down, share buybacks, and dividends. So I think Buffett probably views it that he's going to have more and more ownership in this company over time because of the buybacks. It's in an industry where no one seems to be growing production that much, which in theory should be good for commodity prices, but of course time will tell. And I don't think the companies are priced that egregiously relative to the cash that they're producing, even though commodity prices have been quite high recently. So of course, as always, do your own work on it, but those are a couple of thoughts on commodity businesses generally, and in particular oil. So thank you very much for all your questions in this Q&A, and thank you very much for watching not only this video, but all the videos that I have uploaded throughout the year. Like I said at the start, I hope you all have a fantastic holiday season, a good rest of 2022, and a great start to 2023. That's it from me for this one, and really for the year, and I will catch you in 2023. Cheers.